Hello, investors. Thank you for joining us. So my name is Michael from Deep Value Returns. I run a newsletter about investing where I split a portfolio into half growth stocks, half value stocks, and I call this the hybrid portfolio. And I'm here joined today with Manuel. Manuel, over to you.
Hi, Michael. I'm Manuel, and you can gain access to all my top picks over at allinstocks.com. And today, this is the second episode of Investment for Beginners. And it's a great pleasure to be with you here again, Michael. And our subject today is like a follow-up from our previous conversation, right? About selling stock. Do you want to go first?
Yeah, sure. So this is the most exciting thing, right? So everyone talks about how to buy, everyone kind of ultimately in value investing, particularly, is trying to buy something for less than it's worth. That's kind of the idea. You want to buy low, sell high, how you go about that. You can either aim to buy something that's either falling in price and you kind of average that in, or you can average up. It's kind of, everyone has a relatively same method. When it comes to sell, is arguably what defines you as an investor. For example, you have somebody that's kind of holding a stock for, let's say, a few hours, and that's a certain type of mentality. And then you have someone that's holding it for a few weeks, and that's a certain type of investor. And then you have something that's holding it for 6 months or a year, or something longer like 10 years. So that is really what defines the investor, because ultimately, if you're kind of going for something that's quite short-term oriented, you're kind of having to go through a lot of different investments very, very quickly. It's arguably very, very tense because you're having to kind of come up with new ideas all the time, and you have to kind of react to investing all the time. Whereas if your time horizon is, let's say, 6 months or a year, even longer, it's a different type of investing. And then if you're kind of obviously investing for something for, let's say, 10 years, I mean, that's really kind of very passive, and it's going to be very difficult, in my opinion, at least. Manuel, you might have a different opinion, but in my opinion, at least, if you're kind of holding on to an investment for 10 years, the world is getting so disruptive and disrupted, and it's quite difficult for somebody to outperform the S&P, which, remember, the S&P is already made up of the 500 of the best companies on the global scale. So it's going to be difficult to outperform the best of the best if you're kind of picking an investment and holding it for 10 years, because if you know the base rates of a lot of these kind of investments, they tend to kind of depreciate over a long period of time. In fact, if you look at a company, let's say, of a markup of more than 50 billion, Michael Mobosin, I don't know how to pronounce the name, he works for Credit Suisse, and he kind of has this, he talks about the base rate a lot. And the base rate simply means if you have no insights about that particular business, but if you just look at an average type of business and you try and follow those businesses over a period of time, it's going to be difficult for the share price to outperform the intrinsic value of the business. So if you're having something that you're holding on for a longer period of time, it's going to be quite difficult to outperform the S&P. And how do you see that, Manuel, like about your holding periods?
This is a very interesting conversation. I tend to disagree with you, or at least up to some point. It depends. I would love to own one stock, 2, 3 stocks, whatever, or 100 stocks. I just don't own that many stocks because I just can't follow them. But I would love to own companies for a long period of time, because the more the longer I hold them, the more I get to know the company, the more I get to know the management, if the management is good, if the business, the how do you say, the external factors that influence the business, like the competition, etc., etc. So the longer I hold a company, in principle, I should know it better. That's one thing. Whether it's a good stock or not, because I know it better, that's another completely different thing. But there are some companies, and the other day I was reading this, I think it was by John Huber, I'm not sure about this, but I can check it out later, which was an article or a series of articles about companies that the larger they grow, the better businesses they become. So this was first talked about by Nick Sleep with the economies of share, um, economies of scale shared, like Costco, because it's
And
a
Amazon.
flywheel effect. Amazon, exactly. It's a flywheel effect. The larger they become, the more resilient and the more anti-fragile they become. The other day I was researching a company which is O'Reilly Auto Parts. It's a retailer in the United States, and it basically sells auto parts, right? And you can clearly see, if you go and check its its cash conversion cycle, because it has become larger and larger over the decades. It has been able to negotiate with its suppliers longer payment terms, and it has become really much better than it was at the beginning. So if you bought O'Reilly Auto Parts, and I know I'm singling out one stock, right? Okay. But if you bought O'Reilly Auto Parts 20 years ago, you would have had a 19 point something compounded annual growth rate. And you only needed to own that stock, right? So I'm not saying that it's easy to find those stocks, but it's an interesting argument nonetheless. To try and find these companies that the bigger they are, the stronger they are. So you can just relax. I don't know if
I mean, I
right?
love that. Can I jump in here? I mean, I
Of
absolutely love
course,
that, and
feel free
I'm
to.
very happy, seriously very happy for you or anyone to kind of take an opposing view to me, because that's how I learned and that's how I've learned. And what's more, so at the moment we're doing this on Zoom, and the idea is that over time we kind of get the technology sorted somehow, and we're able to do this live, and people be able to kind of put in some questions and kind of interject, and et cetera, et cetera. So it's quite easy in the case of, let's say, O'Reilly, to kind of look back and said, if I didn't invest in then, I would have done X. On this side of the equation, it's quite difficult as the business grows in scale for it to remain mispriced. So when O'Reilly Auto Part is today, it's very difficult to say that over the next 10 years it's going to compound at 19%, because there was that mispricing 20 years ago. People didn't believe that the business model would be growing as strongly as it did. So I suspect, even if its growth rates remain the same relative to where it was 20 years ago, that the multiples that people are paying right now are much higher, much more extended than they were back then. So you can't expect the multiple to continue getting higher. So taking Nick Sleep's example of Costco, for example, this is a business that I know quite well, much better than O'Reilly. So yes, there is a certain amount that Costco can continue to use that low-cost business model and excel. There's a certain amount. And I know that, for example, there's a quote from Charlie Munger that says that I prefer to own Costco at 30 times earnings than any other business or something like that. And yes, but it's very difficult to continue to do as well as the S&P, because remember, the S&P is already compounding approximately 13-14% for the last 5 years. So it's already, that's already a very high benchmark to kind of continue to do higher. And in the case of, let's say, for example, Costco, it's not able to service every type of user, every type of customer everywhere. So everyone's kind of wanting a more selected type of experience. And what works for Costco in the US when they were expanding into the market, and what works at Costco as they're starting to work in China, man, these are now very mature businesses, and it's quite difficult for them to continue to kind of have that runway that they did have. I mean, so not to isolate specific examples, but like knowing when to sell, that's really, like, ultimately it depends on what type of investor you are. So in my mind, the way that I've tried to position myself is I've tried to be very open with my flaws and say, okay, I'm not going to get everything right, but what I'm trying to do is I'm trying to buy things that people don't really understand. People have this kind of different impression of where the business is going relative to my impression. So it's that kind of Howard Marks thing. You have to be non-consensus and right. It's not good enough for you to be kind of non-consensus and say everyone is wrong and I'm right, but you ultimately have to be proven right. So that's why I'm looking for approximately a 1 year to a year and a half holding period, because in a year and a half, if I have a view of, let's say, a company, for example, I'm happy to say that any investments that we're talking about is just for this interest of discussion. It's not a position that either of us holds, or, it's not investment advice. So anything that I say, I could be selling at any point in time without actually, and Manuel the same. But so I own a company, for example, Fubu, and Fubu's margins are very, very unprofitable right now. So I have a view of where the business can go over the next year and a half. Now, if over the next year and a half, Fubu turns out to be, not progressing along in its profitability, that kind of re-rating that I was expecting to see doesn't come to fruition. So in that event, my idea that I had is wrong. And there's no point me kind of continuing to be contrarian and say everyone is wrong and I'm going to be right, because, I called it wrong. A year and a half later, I had this view. It's wrong. It's fine. It's part of the business. And the way that we touched about it last week is that if you're making a lasagna or whatever, if you're a restaurant operator and you're making a beautiful lasagna, you're going to have some bits of the beef that are going to go in the bin. That's just the cost of making the business. That's the cost of investing. You're going to have some failures. And it very much depends on what type of investor you are. The other side of the equation, where you kind of a more of a kind of a Nick Sleep type of investor, and you kind of pick 2 or 3 businesses that work really, really well, and you're lucky to hit on something like Amazon. Amazon is 0.1% business in the world, probably 0.01. It's a fluke, and it's very difficult even to look at Amazon today. And we look at Amazon, for example, in the case that the consumer is kind of difficult to know what I, Michael, want when I go and look, for example, for a certain type of battery on Amazon. What about in the future, where I can go for a e-commerce business that specifically focuses on selling batteries and it curates to me? So Amazon is not able to give that personalized touch. It gives you everything. And if you pay Amazon, they sponsor your product. And we're just talking about Amazon as in the retail. We're not talking about AWS here, but it's difficult to kind of have it's too much of a blank piece of paper or blank page. And it's difficult to kind of curate. In the case of Costco as well, it's difficult to kind of tailor to Manuel's needs. It's like, what does Manuel actually want and when does he want it by, to remove all those question marks and make it so seamless. So it becomes quite difficult to kind of service everyone, and ultimately you're not really able to have that kind of very loyal customer. Would you say that's a fair thing, or you disagree as well there?
Everything is like every opinion is like a spectrum. It goes from, it's not black or white. There's a lot of things that you're obviously right. Some things that I agree to, and others that I don't really agree as much. For instance, Costco. And I'm a quick disclaimer. I know the basic bird's eye view thesis of Costco, but not I don't know it that deeply. But I guess that it's a flywheel effect, and I'm not sure where it's going and what about the competitive landscape in China or whatever. But it's a flywheel effect that it's really, really, really hard to break. Right? The larger it grows, the lower the costs, and then it passes the costs on to its clients. It's really hard to take, but no real opinion or deep opinion on Costco from my side. But we clearly see some things different from each other. For instance, going back to O'Reilly or to Costco or to any of these compounders, in 20 or 30 years that O'Reilly has been going up like this 19-something% that I've mentioned, you could have bought it several in another way. There's a guy in Terry Smith, right, in England, and he mentioned he's one of these quality compounding investors and all of that. And the other day I was thinking about what he teaches or what he professes, and Costco, Amazon, these compounders, they have always been, the price has always been wrong. Right? So, right? So you can now the margin of safety might not be there right now, but there was a lot of times that Amazon went down, that Costco went down, that O'Reilly went down because of this or that. so there were plenty of opportunities where one could buy into these great businesses, and then we didn't need to buy them when they were startups, right?
Okay,
We could
so here's another example. Let me just kind of give another example, right, from my own kind of argument. If you look at the 90s, there was a businesses, for example, Walmart. There was like not Costco, Cisco. So there were kind of these businesses that were like the bombs. These businesses are undisruptible. Microsoft, just nothing's gonna stop Microsoft from being around in the noughties. So there's a decade, or if you go even further back, you say like 70s or 80s, you got like Eastman Kodak, and you got like Fujifilm, and there's always in that certain decade, the business is going to be around forever. And then you kind of fast forward to the next decade, and they're like, the exception being Microsoft, that was around in the 90s, then it had like kind of that flat line for the 10 years that the stock went nowhere. And then after in the 2010 to 2021, it's kind of just gone back up again. That's one exception. But overall, it's quite difficult for the business that does 10, 20 years as being a star, and then to have another 10 years of being a star. The majority of businesses, like after 30 years, they're kind of dead, and there's sometimes rarely something like General Electric that has a bankruptcy along the way, but for all intents and purposes, it's very, very difficult for the business still to be fresh as it approaches the 4th decade of its life cycle. So there are always, that's the great thing about investing. There are always exceptions to every single case, and anyone can kind of build on like the argument, like for example, Kraft Heinz, it's a business that should kind of, people still want baked beans, people still want ketchup, people still want these kind of things, and they should still kind of be a strong business, but for some reason it just isn't. And these businesses have like, a good runway, and their moments in the sun, it feels, and it's a difficult kind of play, I believe, to kind of, I just think it's difficult. Yeah, I don't know.
No, of course, if it were easy, we wouldn't be here. And this is like someone call it, it's the biggest game ever, right? Investing. So it's obviously hard. And you mentioned three, and not to pick with you, but you mentioned companies, the technological companies, and then you mentioned Kraft Heinz, which has been, and I don't want to go much into that, but which has been disrupted by technology as well, because 20 years ago, 30 years ago, 50 years ago, the big brands were had the money to pay for TV advertising and to go national in the United States and across the world. Right now, with the social media and the internet, notably Facebook and Google and a few other, everyone has access to advertising and to their niche audience, that you were mentioning before. So right now, my girlfriend can buy, I don't know, face creams from a tiny brand in southern France, because they can target this to my girlfriend without needing millions and millions of dollars. So the thing with Kraft Heinz is the democratize, among many other things, among the management and all of that, but is the democratization of the advertising that has
but nobody could have predicted that, right? So
no one.
If you go back the clock 6-7 years ago, when Buffett was getting involved with Kraft Heinz, it's impossible to predict. This is kind of the unknown. But
do you think it's easier to predict the 1 year or 2 years change in share price?
If you look at the book that I highly recommend to everyone, is Super Forecasting. Super Forecasting is a book that shows scientifically that have you read Super Forecasting, the book? Okay, so in essence, Super Forecasting is a book where he does a forecasting tournament where anyone's welcome to join, and it collects data for over a period, I think, of approximately 10 years, but it runs it every year or something. And it shows that people that are very good, not necessarily mathematically intelligent, but people that update their thesis, their ideas a few times a year, can forecast a year out. But nobody could forecast 2 years out, no
But
matter
are
who
we
it
talking
was.
about forecasting the share price or the
No,
business performance?
I mean, it was like, so the book Super Forecasting is about forecasting anything from global war, nuclear, nuclear problems,
Okay.
whether the price of soybeans is going to go up. It's like anything, price of oil, or
Mhm.
nothing to do with investing, really, in a sense. It's
Okay.
just ability to forecast whether two political parties are going to come together at some point in the future, whether Trump is going to win the election or not, like kind of random things. So it's very, very difficult. Nobody can predict 2 years out because these kind of unknowns surface really quickly. That's the first thing that I find.
Mhm.
And the second thing is that there's just so much competition in investing that if something is hitting and working somewhere, that information just gets so quickly transmitted across the market that 12 months later everyone knows about it, and it's like yesterday's news. So it's
The
very
information
difficult.
that there is little informational ads right now. There's much for us small time investors. It's much more of a time horizon. I would say for me, at least, time horizon or behavioral ads rather than informational ads, because that's the computers now that screen every 8K and 10Q and whatever that every report that the company issues immediately. So that one is kind of hard to beat.
Yeah, I mean, I don't have any, I don't know this. I'm just interested in it. But a lot of the big institutional boards that carry, have serious billions of dollars investing in companies, if they're invested in Apple and they kind of feel that Apple is no longer a worthwhile investment, they wouldn't sell out because they have to go for so many lines of red tape, and like it's just so much career risk that you might as well just keep it. So they also have a very long time horizon, because even if they feel that they're wrong, not in Apple's case, but because Apple's going up, but another stock, even if they feel like Netflix is not really pretend as good as it was, you might as well just keep it. So they also have a very long time horizon. So, but I mean, I don't know. I don't know. There's not enough. I don't really know enough about it. Obviously there's a lot of quant computing and stuff like that. So the market is very choppy, and there's all kinds of people playing this game. It's very interesting, but I just feel that it's kind of easier to have like a concrete idea of where the business can go over the next, let's say, year or two, rather than where the business can go in 5 years, because nobody could have predicted coronavirus. Like you look at airline stocks, everyone knows that airlines are prone to terrorisms, different types of viruses, the SARS virus, and there's been other viruses in the last 10 years or so. So, it's a known risk that there are these eventualities that can happen. And the moment the coronavirus came, 3 months later, these all airline stocks just took a hit. So the market is still supposed to be so intelligent and so knowing and so this, but nobody knew anything. So
when I listen to you, and I totally agree that no one knows the future, you cannot predict the future, and but taken to the extreme, you wouldn't even invest because you don't know what's happening tomorrow
I mean,
or the day after.
yeah, but yes. So I personally, I find it much easier to say, okay, let's pretend in the case of, let's say, Fubo versus DraftKings. Everyone looks at DraftKings, a betting company, online betting. People are saying, oh, DraftKings is amazing. It's going to be the only leader in this space, for example, and it's priced really expensively for the amount of unprofitability that it has. And then you can say, okay, DraftKings is the leader in this space. It's priced at a certain valuation. It's possible that some of these other betting players may approximate half or so of that valuation over a period of a year. When investors have a bit more data to see that the businesses are progressing in a similar compounded annual growth rate to DraftKings, for example, and you can try and buy that investment at a slight discount, and you believe that that would converge with the valuation of DraftKings over a period of a year. And if it doesn't, then all bets are off. You kind of you had this idea, it didn't work out, and it's life.
I'm thinking of a few companies that I own, and some of them I've owned for, I guess, 2 years or something. I'm thinking of two in particular, and they're just now becoming, the thesis just now becoming to take place, right? things are happening now, and they are starting to happen. And I believe that at least these two companies that I'm thinking about right now, they have multi-year runways. So I've been for 2 years just watching management execute things, and they didn't. Uh, Things were really slow, but they were happening really slow, really under the radar, and now they are starting to happen, and they will continue. And I'm completely cool with that, because at least I believe, it's my belief, that these two companies are like future monopolies, right, in their own industries. So it's going to be really, really, really hard for the range of outcomes that I expect to happen not to happen, right? Because when they get there, no one will displace them, and in their specific industries. So, but this is my view, and I don't own, not all companies that I own are like this, of course, but I do not mind being like 2 years just watching the management doing stuff, like painstakingly working day in and day out. If the runway is really, really good, and there is a very narrow set of outcomes that I expect, because if there's a lot, and I'm going to let's the other day I was, and to pick one of your examples, DraftKings, the other day I was researching Aspire Global, and I came to the conclusion they have all of these. They're also in the iGaming industry now in the United States. That everyone is opening every state is opening regulation for the iGaming and all of that. And I was like, the company is growing a lot. It's not expensive as its competitors, but there's no really guarantee. There's no moat, no barrier to entry. Everyone can enter, do the same as Aspire Global or any of its competitors. So I just didn't invest, and I was writing to my subscribers, this company can become a 10-bagger. I'm not saying that it won't become a 10-bagger, but there is no, for my opinion, for my liking, there's no guarantee that there is a floor that the company cannot vanish tomorrow or in 5 years, because there's no barriers to entry. So the ones that I really like to invest in are those that are really, really hard to displace. And in doing so, I don't mind taking a longer view than 1 or 2 or 3 years.
But so in the example of your two companies, so you get a certain amount of, let's say, re-rating, let's call it, where people are starting to appreciate that the business.
Not sure if it's re-rating. It's more of a growth, not exactly the multiple re-rating. Is the growth, the operations are the companies are selling more product or more services, more than the re-rating.
Okay, so that's different. Okay, but yeah, okay. In any case, if the business obviously is growing a bit stronger and becoming more of a moat and increasing its value, you will inevitably get some re-rating. You know, that's just how it works, right? As people have a stronger opinion, people have higher confidence on the business, it's inevitable. People pay a higher valuation. You pay a higher valuation for PayPal today than you did 5 years ago, because you just know that business is never going to go away. So it's just how it happens, right? So you do get a re-rating of some sort. But at some point, just from a risk management perspective, you are put in a position where your business grows to, let's say, 40% of your portfolio or something. You have to, do something about that. So how would you do? Let's say, fast forward, Manuel, another 2 years, and it's 40% of your portfolio. One of these businesses, 40% of your portfolio. What do you do in that scenario?
I am yet to think about that in a deep way. Okay, they are each one of these companies 20% of my portfolio, right? Almost at the start. Now it has doubled already, so it was 10%. And I do not intend to trim or to sell, because I can see it in 10 years becoming 10 times bigger. Okay, so for now I do not intend to sell this company nor trim it if it goes up and it becomes an even larger part of my portfolio. And I don't believe that will happen, because I also, of course, right, I'm confident that the other stocks will grow as well. Okay, let's see. In a couple of years from now, we can have this same conversation.
But I suppose so I spent a lot of time thinking to myself what type of investor I am, and
Mhm.
it's part of the kind of the pros and cons of the type of investor that I set up myself to be. So I'm looking for a re-rating, and I'm looking to exit a position. So I'm just trying to get the compounded annual growth rate at 15 approximately, or higher. Everyone wants to make higher, of course. So I'm just kind of so that's my mind in the portfolio. I don't need one position to go well. I need the portfolio to compound the 15%. So
How do
it's
you
always,
see the taxes issue on that? Because whenever you sell, you pay taxes, right?
yeah. So
How do you think about it?
yeah. So essentially, the way that I do it right now is I'm managing via an ISA. This is a tax-free package that you do in the UK. So there is no real tax consideration because it's a government that lets you kind of put capital there.
Is there a limit to that? An
Yeah,
amount?
there is a limit,
Okay.
but you can put it to yourself, to your partner, you can put it into your pension,
Okay.
and her pension. So, and you can put it to your children as well. So there is enough. There is enough that you
Okay.
can kind of still put away. That's not a problem. It's a great advantage of actually investing as a UK investor. But I mean, even beyond that, in my mind, so okay, so I've got a 5-year track record that is going to finish next month. A month in the stock market is a very long time. Let me tell you, anything can happen in a month. And not to brag, but whatever, just for the sake of conversation, I'm hitting at the moment 22% compounded annual growth rate for 5 years. So
Congrats, Michael.
yeah, I've worked very hard. But anyway, I'm not. So in my mind, even if I had to pay the 20% hurdle as an investor, capital gains tax, because you can offset to the losses and stuff like that. Even if I was to take and pay the 20% tax once I have enough money that I'm not putting it in the tax-free brackets, it would still be okay. I'll still be compounding at, say, 15%. So a lot of people say, oh, I don't want to kind of take a win off the table because I don't want to pay that 20% tax. But then the market is going to take it from you because no business lives in the stars forever, So you can either take the profits off the table when you want on your times and pay the 20%, or it's going to miss a quarter. Businesses always go for good times and bad times, good times and bad times. It doesn't go like a straight line. So you can either take the profit or the market will take the profit. So again, everything comes down to how you are as an investor. I spend a lot of time thinking about this. So I get this question from my newsletter people all the time. How do you think about the profits? And I just say, take the 20% hit, or 25, or whatever the capital bracket that they are, because if for leaving that capital on the table, it doesn't mean that just because the share price is high today that it's always going to be high. Things happen, and I personally feel that it's very important to move the whole portfolio forward at a certain compounded annual growth rate, rather than just say, yeah, I invested in Microsoft in 1999 and I still hold it today. Yeah, but if the rest of the portfolio isn't doing very well, and the whole portfolio as a whole isn't doing very well, so what? You got one win. Yeah, I'm not saying you. I mean, just generally conversing this tax conversation, I find it quite interesting. Yeah.
And I think we're almost reaching the end.
Definitely.
And we didn't talk about, well, at least I had a few notes on when to sell the stock, but I guess we can take it to the next week, leave it to next week.
Yeah, I think that's good. Okay, guys, thank you for tuning in, and we'll see you next week. Bye-bye, everyone.